Hi, good afternoon, everyone, and a very warm welcome once again to Lawgical Talk, 36th edition today. Um, I can proudly say that we have successfully completed the 3 rounds without any miss any month. We started in two in and we did our first webinar in May 2023, and it's April now and 36 webinar. Thank you so much for all the support which we have received from everyone. I could say that in all these webinars, we would have received more than 30,000 plus registrations, and 50% to 60% of them would have attended also. So that many people would have attended. So it's been that your continuous uh, encouragement by registering yourself, by coming back to these webinars again. That has really helped us, that has really kept us going in terms of searching for topics which are important. Also aligning with the industry in bringing the speakers who have authority on those subjects. And I'm again very happy to bring our speakers for today. We'll come into their introduction. But before that, I'll just do my customary slide and then give everyone 2 more minutes so that more of us can join. So while I'm saying is, I exactly know and I've kept repeating that you know what I'm going to say. Lawrbit is one of India's leading regulatory technology company. We are primarily helping clients manage their regulatory risk, not just in India but globally through our flagship product called GCMS, Global Compliance Management Solution, and I'm assuming most of you are using it already. Um, Beyond GCMS, we also have solutions like legal matter management, which helps you manage your litigations, notices, text matters, or legal matters, and your for internal financial controls, we have solution called IFC. Beyond this, we also help clients to know their regulatory compliance status through compliance health checks and other advisory support services. Uh, we are providing these services through our clients, not just in India, but globally. Today, we have 650 plus entities who we are serving around 42 plus countries and in around in almost 50 plus, around 50 industries. You possibly name an industry, you would have somebody, we would be serving someone there. Uh, as we speak right today, we are a team of 106 legal and technology professionals, which is one of the largest team size of legal and tech professionals serving uh, compliance, providing compliance technology solutions in India. All right, now I'm sure most of you would have attended our webinar on Income Tax Act 2025. We did 2 months back in February. And that time also we specifically mentioned that that was series one. And now here we are back with series two, going slightly more deeper in the subject. And I want to thank Sai to keeping your promise of coming back as a speaker for part two as well. So you attended this last webinar would have already known Sai, but just to give you a quick introduction about him, he is a chartered accountant with almost 10 years of experience with a strong understanding of finance and strategic advisory. His expertise is in the wealth and he has an expertise in pharma, information technology, hospital. Basically, he has worked across different industries, and he would be our speaker talking on specifically the changes which is impacting not just on entities but individuals like us also. And we'll get deeper into it. Thank you, Sai, for coming in here, and welcome. Looking forward to hear you.
Thank you, Jen. Good evening, all.
Great. And also I have Ms. Shali Gupta. Shali, thank you for your time. Over the last couple of weeks, I would say that we have taken a lot of her time and a time of her team in preparing for this. We've gone on to the drawing board multiple times in terms of isko cover karenge, isko nahi karenge, and we've till as recent as yesterday we were redrawing our slides as to what we should bring in this limited amount of time, which really brings value to everyone. And Shelly, this is, your involvement until the last minute. That was truly amazing. And it showed how much you really want to bring the depth into what we are speaking. Truly admire that, and more excited to hear your thoughts today on the. Shelly is a partner with the Ketan and Company, and I'm sure the kind of public figure she is. I'm sure a lot of you would also be knowing her. Maybe somewhere you are interacted with her in your existing companies, previous companies. She was a lawyer and chartered accountant with around 15 plus years of experience in direct tax, and she has also been awarded in multiple and awards, and recently as a India's Future Legal Leaders 2026 by India Business Law Journal, and she is also ranked as ranked as recommended and key lawyer in Legal 2000 as a Legal 500 by Asia Pacific ranking 2026. She has also been felicitated with the Long Strider Award by Delhi University for excellence in the profession. Excited to have you here, Shelly. Thank you so much.
Thank you for that kind introduction, Jayant. I also look forward for this webinar.
More excited than you. So let's get started. What we are going to cover today, we are going to be decoding the Income Tax Act 2025. As I said, this is the second series. So here we are going to also first talk about impact on the salary income. What are the overhauls? Okay. There were some changes which were brought in, and we will go deeper into how it's going to impact, whom it is going to impact. Key TDS updates, what all you need to know. Major changes which has happened in audit and transfer pricing reporting, and day-to-day impacts on our tax filings. What changed? What are the new forms? How we are transitioning, into new framework. What kind of readiness we require? What kind of practical challenges which we are going to, which we're forcing, because as we are transitioning from one to another, it's not that we completely cut the first one and moving to the new one. Right now, people who are dealing with especially the direct tax, they are juggling between two. They have to remember all the forms, the new ones, where what's going, because what I've experienced in the tax professionals specifically, they work on reflexes, like we drive, so they know kaun sa entry kahan dalni hai. And I think some of the time they don't even know where they are doing, but they are most of the time they're right. Almost every time they're right. So when it's not a small change, I think it's a big change because our reflexes are going to change. So what I think we are going to delve deeper into it. In between, you have questions, please, as you all know, you keep sending your queries in the chat box. We will try and take as many as we can. Specifically for this, because it's direct tax, which is impacting everyone, every organization, and almost every individual. We have taken more time. We have kept this to 1.5 hours session today. So we will try and address as many questions also as we can. So let's so Sai and Shelly, just before I hand over to both of you, just want to ask you, and want to take your opinions. What was the need of moving to a new income tax 2025? What is the government's thought process behind it?
See, Jayant, we had been living with an Income Tax Act which was more than 60 years old, which had become increasingly bulky. We had so many amendments. The 61 Act was amended more than 60 times with 4,000 plus amendments. So there was certainly a need to streamline, remove the redundant provisions, simplify at least a lot of controversies which have been settled. They try to put the entire law into a very simple, easy to understand format. So while we have been hearing from the FM that there is no policy change, which we will discuss really what the changes have been brought in, but I think in terms of simplification, it was definitely the need of hour. And the FM has successfully achieved that objective.
Great.
And to add on to that, so definitely now increasing the taxpayer base across the country, it is necessary to understand, to make the law very simple language so that every taxpayer will understand and implement, rather than using their complex language, complex provisions. That makes the necessity to change from 1961 to Income Tax 2025.
And also, as I think, when the income tax 962 that came in, I think that was time. I think this tax was only for the elite class because nobody was paying taxes. I think today, with the taxpayer basis also increasing, I think it's a high time when this it needs to become more simple so that and every individual can understand. I was today morning I was reading some provisions of if you have done a TDS deducted TDS on rent or any payment to a builder. Typically, as a small regular taxpayer, I don't even bother about going and filing a TDS return there or submitting my TDS which are deducted. So, but now the provisions have become more stringent there. I think this tax also is, or this act also is getting used by individuals more than I think ever before. So ideas, I think, also resonate there. Make it simple so that people can understand and we can increase the tax base as well. Thank you so much for the thoughts. So let's start with Imachi. Let's move to the next slide. And Sai, I would request you can start with how it is impacting the what impacts are that it has on the salary income right now.
Yeah, sure, Jen. Because at any point of time when a new budget comes on February 1st, the lot of middle class taxpayers, especially salaried class, will comes a lot of expectations. So what is going to change and what are the new changes? Is my basic exemption limit getting increased? ATC being increased? So, but this Finance Act 2026, there is no amendment with respect to the income tax for salaried class. But there are certain amendments with respect to income tax rules within the Income Tax Rules 2026. So even though the basic exemption limit and all the tax rate was not changed, but certain allowances exemptions was certainly increased by 3 times or 5 times in income tax new rules. Per se, first we have the HRE allowance, where earlier we have only 4 cities which are covered as a metro cities like Chennai, Kolkata, Mumbai, and Delhi. Now it was expanded to 8 cities, which adds Hyderabad, Pune, Ahmedabad, and Bangalore. So what happens is now I have 8 metro cities as per income tax, which have 50% of the salary as per the same formula is getting exempted as part of HRE allowance. So that is with respect to HRE allowance that was amendment in the new income tax rules 2026. Similarly, we have other allowances like children education allowances, hospital expenditure, where there is a significant rise in the allowances limit, exemption limit from the previous income tax rules 1962, which was 60 years back, and considering this today's inflation rate and today's the cost of living. For the children education allowance per se, it was increased from 100 per month per child to 3,000 per month per child. Okay. And similarly for hostel expenditure of the kids, even it was increased from 3,000 per month per child to 9,000 per month per child. Meals coupons, earlier it was 50 per meal, now it was 200 rupees per meal. Gift vouchers, we have 5,000 rupees per year, now it is 15,000. And similarly, all the allowances, what we have exemptions the previous 1962 rules, it was significantly increased except for the transport allowance, which is for general employees. So that brings having one increase limit in the per se, and also the revision of new labor code, which mandates 50% as the basic. Now the employees who wants to decide depends upon their salary structure, depends upon all the exemption and the allowances limits to decide whether they comes under old regime or new regime, which is beneficial for them. To be in a nutshell, for the employees, whoever, whether it is at an old or new, whatever the salary structure is, if the limit is less than 12 lakhs, the salary is less than 12 lakhs, it's a blind, the new regime is more beneficial. And if it is more than 12 lakhs, then we need to see what exactly the components in the salary, which is more beneficial for them.
So in a way, some kind of a breather for people who are still filing under the old regime has been given, because these limits won't benefit anybody who is filing under the new regime. Is my understanding correct, Sai?
100%, because it gives relaxation to people who opted for old regime, but not for any new regime people.
Okay.
So now we have seen the allowances which have been increased from the old income tax act to new income tax act. But with respect to the rules like standard deduction, rebate, and ATC, ATD, income tax rates, and old tax rates as per the income tax rates as per old regime, and income tax rates as per new regime, everything was same. There is no changing. Only the change was they have refined the section numbers, they have refined the form numbers, they have refined the rule numbers. In addition to that, there is no much change. The same limit of 12 lakhs under new regime continues as a basic exemption as a tax-free taxable limit, and where the 60,000 rebate still continues. And the standard deduction for old regime 50,000 still continues, and 75,000 for new regime still continues. ATC limit 1.5 lakhs for the old regime is same. There is no change. Even the new income tax 2025 is came, and the medical limits, which is of 25,000 for self and family, which are non-senior citizens, and 50,000 where self or any of them were senior citizen, still stands same. So in a nutshell, everything was same with respect to the tax rates and the limits per se, with respect to the standard deductions, ETC limits, and the tax rates. The only one thing as a salaried class we should remember is earlier any salaried employee will ask form 16, please share the form 16 so that I can go for file income tax returns. Please share form 16, I can go for apply for loans. So the form 16 has changed to form 130. So we should be more familiar to that so that from the next 26-27 financial year onwards, we should ask for form 130 instead of form 16.
I think that's the only form most of the salaried people really know and really bother about. So we have to, we have to change this also now.
Yes.
Okay. So, but what we are essentially seeing here is it's more of a restructuring which has happened, in the forms. But as such, there is no major change. Or have you experienced any kind of a changes in, the way the forms are structured or the way information is captured? Or
with respect to the forms which are relevant for salaried employees, there is no change. Which is form 130 or form 123 or 124, everything was same. But only the change was that for the salaried class employees, the limits increase in the limits for metro cities and other relevances.
Okay.
I think Shaili, if you can add something to here, I think please go ahead.
Sure. So I think, Sai, you very well covered the increased, exemption in the allowances. I think the only point which I would additionally like to highlight is the reduction in the tax efficiency of certain benefits like car lease because of the revised perquisite valuation. And this is especially relevant for employees in higher tax brackets. So employees may now find that the tax cost may outweigh the perceived benefit, especially amongst the senior management who would traditionally opt for card lease structures for tax efficiency. But on the other hand, and I think I also see this question in the chat box, meal benefits are now available under both regimes. So earlier, as per the 1961 law, there was a specific bar on claiming meal allowance benefit, the meal coupon benefit under the new regime. Now, in the 2025 Act, we see a slight change, and this meal voucher will now be available under both regimes, which makes it a tax efficient product for a very larger employee base. So meal benefits will now make them very attractive going forward. And we are already seeing inquiries from companies who are evaluating, expanding and structuring employee benefit programs to include such meal cards. I think there's another question in the chat box with respect to 200 rupees, whether 2 meals can be allowed in 1 year. So yes, I think depending on the working hours, we do take a position that 2 meal benefit in a day can be allowed to the employees, which gives you leeway to plan and structure your compensation in a better mechanism. And thirdly, with respect to old versus new tax regime, I see a lot of questions in the chat box around what is allowed under new regime, what is not allowed under new regime. So I think, we've been receiving several queries from clients to evaluate various different kind of their payslip structures. Meal coupon is one change that we've seen in the new act, but largely what was allowed under the earlier act under old regime, new regime, is largely the same even under the new act. However, with the enhanced exemptions and reductions which Sai just briefed us, which is now available under revised rules, employees, I feel, may find old regime comparatively more attractive than before, despite the new regime being the default option. So I think this creates a need for employees to reassess their tax position, factoring in these eligible deductions and allowances. And from a practical standpoint, to my mind, employers also need to support this through the regime comparison tools, guidance to help employees choose between the regimes, which becomes, I think, more case specific and nuanced issue today. So I think it is time that companies work on optimizing compensation structures, including comparing old versus new tax regimes, reducing these inefficient perquisites like car lease, maybe switch to an employee-owned car, and introduce flexible benefit plans. And with the labor code assessment, which is already being, wage code impact assessment already being undertaken by companies, I think the revision in IT rules are really well timed. And employers would now not be required to undertake the restructuring exercise twice. And with their labor code wage impact assessment, they can also make the wage structure tax efficient.
Just one very basic question. So let's say last year I chose to be in a new regime, but now I'm finding the old regime attractive. Can I still move to the new, to move back to old regime?
Yes, Chayan.
Yes.
One can switch between the regimes.
One can still switch. Okay.
Provided if you don't have any business income.
That's right.
Okay.
So I think I'll just walk through this update in TDS provisions. Now, presently, we have section 190 to 196D, which is like more than 30 sections. And the entire TDS and TCS sections were, in one chapter, roughly together 69 sections. Now, what the revised act has done is all these sections pertaining to TDS have been combined into one section 393. And all the TCS sections are merged into single section 394. So this is a simplification measure which has been brought in so that you have, I'll walk you through the format of 393 first. So section 393 is divided into 11 subclauses, 11 subsections. Now, subsection 1 deals with payment to residents. Now, you would see in the new act, there is a table which specifies the nature of income, payer, rate, and threshold for payments to be made to residents. Subsection 2 deals with a similar table for payment made to non-residents. Subsection 3 thereafter provides TDS rates and thresholds for specified payments. For example, winnings from lottery, gambling, horse race, cash payments, payment to a partner in the firm, and so on. All of these specified payments are included in subsection 3. Then you have subsection 4, which lists cases where no TDS is required into one table. For example, if there is any payment of award under Reflector Act, there is interest and dividend payments, some specified interest payments where TDS is not required, rent payment to REITs, commission paid by BSNL, MTNL. So you have all these different kind of payments where the TDS is not required, put together into one table. Now, this is how, all the different buckets of payments and TDS compliances are put in very user-friendly, legible tables into the section. And then you have subsection 5 to subsection 11, which deals with the procedural part. So whenever you have to make a payment, you simply have to go to section 393, see what is relevant, subsection 1, 2, 3, 4, identify the rate and the threshold. Now, 393 provides only the rates. For meaning of all the terms, the section 402 is provided in the new act, which includes all the definitions that are relevant for purpose of this chapter 19, collection and recovery of tax. So for any TDS inquiry, you need to see 393, 402, and you get the answer under the new law. Now, the only change which we have seen in the new act is with respect to filing of correction statements. Now, historically, deductors could file unlimited correction statements without any statutory time bar. So now this often led to misuse and backlogs, and also used to cause a lot of difficulties to payees, because at the time of filing tax return, payees would see a tax credit, which was later, because of correction statement, it used to disappear from their Form 26AS. They would be denied a tax credit, and there would be scrutiny and issues in the hands of payees. Now, this problem was plugged by bringing an amendment by Finance Act number 2, 2024 in section 200 of 1961 Act. Now, with that amendment, the open-ended window was curtailed to 6 years, which now under 2025 Act has further been reduced to 2 years. So now the objective of this change is to bring certainty and finality in records. Now we are living in an era of, AIS, which provides real-time reconciliation. We all are aware that the government is moving in a direction where you have literally all the details of transactions in AIS, and your ITR filing becomes very easy at few clicks. So with that objective in mind, the government has reduced the correction statement window to 2 years. Now, this amendment is made effective from April 1, 2026 and covered under Section 397 3F of the new Act. Now, let us see what are the timelines that are relevant today. So if you look at your screen, the first example. Now, if we have a TDS return for salary for tax year 26-27, now as per the timeline, it is to be filed by 31st July. Now, section 397 provides that a correction statement can be furnished within 2 years from the end of the relevant financial year. So which means that correction statement can be filed by 31st March 2029. So this is how the amended timeline comes into play. Now, I think another question which you'll have in mind is that what happens to past years? Now, let us take example for financial year 23-24, quarter 1. Now, the due date for TDS return filing in this case is 31st July 2023. Correction statement in this scenario, because will be if we have to file it today. Now, well, let us calculate the limitation period. End of financial year becomes March 24. And if you add 2 years, the limit expired on 31st March 2026. And the same limit would apply until quarter 3 financial year 23-24. So as of today, correction can be filed Q4 23-24 and for later periods. If you see the TDS rates and monetary thresholds for all categories of payments, they have been retained as they are under the Income Tax Act 1961. Now, as I mentioned, the consolidation of TDS provisions under 393 is only a simplified tabular presentation, and there is no change in the TDS rates. FM has been very clear that we are not making policy changes, which is truly reflecting in the TDS provisions. There's no change. Now, the only change that you see on the screen is in the form numbers. Your TDS returns currently are filed in Form 24Q for salary payments, and other than salary payments, it's filed in 26Q, which are now replaced by form numbers 138 and 140. So that is the only compliance change with respect to TDS provisions.
Yeah. So as Shaili covered what is the changes in the TDS section numbers of framework and the structuring of the TDS provisions. With respect to the due dates to file the TDS returns or to make the payments, there is no change in the due dates. So, however, what are the dates which were earlier in the Income Tax 1961? Same, the due dates have been incorporated in Income Tax 2025 as well. Like, for example, for every month, the due date to pay TDS is 7th of the next month, except for the month of March. Still, it stands same for every month. We need to pay the TDS and then 7th of the subsequent month. For the month of March, we can pay TDS till 30th April, which is the 30 days time we'll have the framework for entire March month. Similarly, as I mentioned before, the Form 16, which is a more usable form, has changed its number to Form 130. Similarly, the TDS certificate, which we issued for non-salaried employees, like any contractor, any professional, which we term as Form 16A, that has also been renumbered as Form 131. Form 16 is 130, Form 16A is 131. It's just renumbering of the form. There is no much changes in that. Similarly, as we have the TDS returns, which is the Form 138 or Form 130, which Shelly has mentioned, the due date stands still same, like 31st July for quarter 1, 31st October for quarter 2, 31st January for quarter 3, and 31st May for quarter 4, where we have 30 days time after completion of each quarter to file the TDS returns. And one significant amendment with respect to change with respect to TDS return forms is the salary return, which was earlier 24Q, has changed its number to 138. Similarly, the non-salary TDS return, which is 26Q, has changed its number to 140. And the non-resident, which we used as 26Q, which we used to file for the payments for non-residents, which we did it under section 195 or any other section which is relevant for non-residents, that was changed to 144. And one point which sections different forms 26QB, which we used to file for any payment of consideration on purchase of any immovable property which exceeds 50 lakhs. 26QC, which we paid for rent, which is exceeding more than 50,000. 26QD and 26QE, which is for payment of contractors, and 26QE, which is for of cryptocurrency. All these have been changed to one single form, which is Form 141. And one significant amendment which we should note at this point of time with respect to Form 141 is, earlier in 26QB, if we have three buyers who are buying one property, and 3 buyers have 3 sellers. Now what happens? Each buyer should file Form 26QB 3 times because they have 3 sellers. Similarly, the second buyer also will file Form 26QB 3 times. The third buyer also will file Form 26QB for 3 times. So when they have 3 buyers and 3 sellers, the Form 26QB is supposed to file 6 times, because for each, 9 times, each will file 3 26QBs. Now Form 141 has been reframed and the form has changed in such a way that in one Form 141, I can mention multiple sellers. Even though I am buying for the joint property, which I am buying from one husband and wife as one single name, earlier I used to file 2 Form 26QBs. One is on my buyer's seller husband name and also wife's name. Now it was simplified that I need to file one Form 141, which will suffice. That's one simplification brought by the income tax new rules, which we should, this is a very relaxing rule, so that it is not much redundancy of forms we need to file, and then for every form the correction is much long process. Similarly, the TCS return, which is a 27EQ form, has been renumbered as 143. And with all the new forms with respect to TDS, Form 138, 140, 144, and 143, there are minimal changes that have been brought in these forms. Now, as I mentioned, there are what are changes with respect to Form 141. We have also certain changes with respect to Form 138 and 140, which we'll discuss in the next slides. Let's speak about Form 138, which is the form earlier 24Q. If we understand earlier 24Q, it has 3 annexures. One is the basic details. What is challan details, how many challans we paid, the challan date, BSR code, challan number, amount, for which bank we paid. All this we have on annexure 1. Annexure 2 will give the, which is we did deductive-wise details. So which party we are supposed to, which part with the PAN number, their total gross amount paid, what is the date of payment, and what is the amount that we are giving it as TDS credit. And only for the Q4, we have separate annexure, which is annexure 2 in 24Q, where we'll give entire their salary details. What is the gross basic salary, HRA, allowances, ATC, ATD, and that's where the Form 16 will generate. What are the information that you give in annexure 2 of 24Q. Now that has been very simplified way with respect to 3 changes majorly. The earlier we should have the surcharge, education cess, second education cess, those fields have been removed. So now you have only the tax amount, that's it. It's a very simplified, they have removed the redundant fields. And the very old fields like token number, TAN registration number, those also have been removed. So now we have a very simplified form. We have the tax amount and the deductive amount, just simplified. And now in this particular Form 138, which is the old Form 124, Form 24Q, the change was they have added annexure 3, that is specifically for senior citizens, where the pension or any interest which is relevant to the senior citizens, for that, NHZ 3 is to be filed. So to summarize, Form 24Q, which is earlier form, if you are filing for Form 138 for the new form, Annexure 1 will have entire challan details, the deducted details. Annexure 2 will have the total employees details, where we have all the employees, their salary structure, PF, ESA deductions, what are the details with respect to allowances, exemptions, perk visits, interest on education loan, interest on housing loan deductions, everything needs to be entered in Annexure 2. If any senior citizen employees are there where you are offering any pensions, if not, then Annexure 3 is relevant. In such a way that the format of the entire 24Q has been reframed and made simplified in 138. And the government has also mentioned that Form 138 has been more auto-populated mode from traces profile. It will have more auto-pick features and drop-down features and more access with the integration with API, so that there is no manual, there is a minimal intervention of the manual data entry in Form 138, so that the errors have been minimalized, the redundant fields have been removed, and make Form 38 which is relevant at this new era. Those are the few minimal changes which have been brought in Form 138. The similar changes have been also brought in Form 140, where the redundant fields like token number and registration number has been removed, and removal of all surcharge and cess details, because anyway we have entered the tax amount, that is sufficient, and what the redundant references have been removed. And as I claimed before, regarding what are the features with respect to the automation of population of all the entries and drop down options and fetching of all the entries from through API from traces portal and from income tax portal, they have been replicated in Form 140 as well. So in Form 140, if I speak, there is no much changes with respect compared with 26Q. It's as minimal as that. On Form 138, which is earlier Form 124Q, has its changes with respect to the Annexure 2 and Annexure 3.
I think you also answered one question which we got in chat box. Is there any change other than the form numbers? Well covered. Shall anything you want to add? Or we move next?
I think there's one very interesting comment in the chat box that 393 section is more confusing than the previous ones. So I'll give you a very classic example, and also taking cue from what Jayant mentioned in the beginning of the session about reflexes. We were looking at, while preparing the deck, we were looking at, one of the exchange in thresholds for payment of dividend. Now, table 1 said that the threshold is nil for payment of dividend. So, your immediate reaction is that, okay, there is one change from 61 Act to 25 Act. But when I looked at the table 4, which talks about cases where TDS is not required to be made, it mentioned that when you make payment of dividend to individual, the threshold of 10,000 is brought in there. So yes, there is confusion. I mean, confusion in the sense we'll take time to get, used to reading the new act. What is particularly important, and, I can tell you with my own experience, we are getting several queries on what's available under the new regime, old regime, what's the change in perquisite values. So, a lot of allowances that were covered under Rule 2BB previously and now under 280. So I was reading the last subsection, which says that, some of the allowances are allowed under the new regime also. Now, when I read 2BB, it talked about, I think, clause ABC. New to Rule 280 talked about ABCD. So I was very inquisitive to see what's new available under the new regime, what can be advised to our clients. So incidentally, what I discovered, some clauses were split. So there was really no change. So a very careful reading of the old and the new provision. You will have to read and reread the new section, new rules. They've done a lot of shifting up and down, I think, which is the point of confusion which all of us will face. Even we as tax consultants, I have to read the hard copy. I have to do a Control F in the parallel reading utility. So that's some increased burden and confusion. Definitely, I agree with Sri on this.
So on a lighter note, will ChatGPT be as confused as the professionals also?
I'm sorry, Jen, didn't get you that.
I said on a lighter note, will ChatGPT also will be as confused as the professionals on the new text?
I'm sure.
No, ChatGPT was not updated for income tax 2025 when the Gemini was updated on that.
Okay.
I'll take this up then. So I think we've been, there's a question that are there really changes in forms? So I think one of the most challenging change that I see in the new forms is one for tax audit, and subsequently we'll cover transfer pricing, where I believe there have been significant changes. So let's see what are the changes here. We had section 44 EB, which is now the new section 63 under the new act. The penalty for non-compliance, there's no change in the penalty, but 271B is now the corresponding section is section 207 under the new act. Now let's see what has structurally changed. If you look at the table on the left bottom side, which talks form structure. Now currently there was form 3CA, 3CB, and 3CD, as we are all aware. 3CA was applicable where accounts were audited under any other law, and 3CB audit report was where accounts are not audited under any law. 3CD used to cover all the particulars. Now, under the new rules, there is a single form called Form 26. Now, the 3CA, B, and D are covered as Part A, B, and CD of the new Form 26. So the first change, we don't have three forms, we have a single form with these three parts. There is no change in the monetary threshold for applicability of tax audit, that remains same. Now, we'll discuss the changes, but essentially there are 9 new clauses that have been added in the new Form 26. Now, before diving into what are those 9 new clauses, just giving you an overview of what has changed. Now, the terms assessment year to align with the language of the new law. There has been very intelligent structural revision in the form, and this is something that I personally like, in all the forms that I have seen thus far. So if you look at the new form, it breaks down all the clauses, put them together into separate buckets. So whether it is with respect to income, expenses, audit, bookkeeping. So all of that have been categorized into separate buckets, which makes the forms very intelligent and user-friendly. So that's a very positive change that I see. We see a lot of schedule-based reporting into the form. So you have a crisp form running into several clauses. And wherever certain app clauses are applicable, you click a yes under the drop-down, and then you fill the details in a schedule that follows at the end of the Form 26. So which makes it very cleaner and easier to take a holistic picture when you read the initial clauses of Form 26. There are several new disclosures that have been added, which is precisely the new clauses I mentioned, and we'll be covering it in the next slides. Now, the overall change that we see in the new form has certainly added work for tax auditors, consultants, your in-house tax teams, because they'll be now granular reporting. Changes which we'll walk through now requires auditors to put in financial impact. So when there are numbers that are quantified and reporting, there will be increased reconciliation effort, both on part of the in-house tax consultants and the tax auditor. So that's one change. And we are talking about this change becoming effective April 1, 26. So while the new tax audit form will be filed in 2027, but that will be with respect to your tax year 26-27, which has already started. So when I walk through the changes, you need to keep in mind what's applicable in your case, and you cannot think about the changes at the time of tax audit. You will have to bring in necessary changes into your systems now so that we don't get a shock in terms of what will be reported next year, because you cannot retract with any of those filings next year when it becomes due. Then I think what the overall change that I've seen is, as I mentioned, there is financial impact that's mentioned. So I see a lot of data will be now machine read. So we'll have some quantified inputs, which will be very easy for the tax department's analytical or their AI systems to read and make whatever disallowances or scrutiny the tax authorities would like to make. So the risk of data mismatch and scrutiny is now very significant to manage from day one. I think when 143.1 became computerized, at that time, I think about 5 years back, we used to see a flurry of notices because a lot of data mismatch used to happen between what's reported in the tax audit report and the ITR 6 form for companies or whatever form is applicable for individuals. So I think, everyone needs to gear up with the changes so that we do not end up in the same situation now with the changes in the tax audit form. So we'll see now what are these changes really, in the form. So Form 3CA, which is now Part A of Form 26. So this is the tax auditor's observation report. I mean, the report, which earlier used to carry note on the observation, qualification, and disclaimer. Now, what has changed if you look at the reproduction, item number 3, now your serial number and nature of observation, qualification, adverse remark, disclaimer remains the same as was there previously. But now what has been added in the form is increase in profit, decrease in loss, decrease in profit, increase in loss, and net impact. So the tax auditor, with respect to every observation, will have to quantify the financial impact and cite it in the tax audit report itself. Now, here I would like to highlight the intent of the government. Now, the government has also issued FAQs. Now, with respect to this change, what has the government said? They say that this change will enable department to ensure that statutory audit findings are incorporated into the computation of income if so required. So now, because these observations will have financial impact, you are required to take the effect of those as is applicable in your taxable income computation. So which means, what can you do today? If you know that historically there have been some observations, please try to fix that today so that, we don't end up in a situation that we are forced to make an adjustment to taxable income in the next year with respect to ongoing tax year. The next change here is serial number 5 that we've reproduced. This is also part of part A of the form. Now, there is a very onerous obligation on the tax auditor to, even with respect to each and every clause disclosure from 9 to 53, for each clause, wherever there is a qualification, the tax auditor has to mention the reason whether the tax auditor is opining based on test check basis, based on management representation, or was he just unable to verify? So that qualification or observation will have to be given for each of the clauses in the tax audit. Again, now, if we look at the intent of the government, what has the government said in FAQ? Government has written that this will help the department in analyzing the audit observations qualifications in an automated, standardized way, and will help in deciding the remedial course of action, including selecting the cases for further scrutiny. So clearly, to my mind, these reporting, which quantifies the financial impact, needs to be carefully looked at from beginning of the year, so that we don't end up into, any disputes or difference of opinion with the tax authorities. And similar to these changes, which the tax auditor is required to quote, in case of companies where there is a requirement for cost audit, we have a similar reporting, included in clause 12, which we've not reproduced here. But in clause 12, any impact of disagreement or disqualification in cost audit and and similar reporting with respect to increase, decrease in profit has to be reported in the tax audit itself, the tax audit report. So these are, these are first important changes that we see in the tax audit report. I think the next and very interesting change that I see is with respect to the reporting of 15 CA numbers. Now, let me just first give you a background. Now, the erstwhile Form 15 CA is now Form 145. This form is required to be filled in by the company while making remittance to a non-resident, and where Part D is applicable in a case. Part D applies where the income is not chargeable to tax as per provisions of the income tax without considering treaty benefits. So all this data was already available with the tax authorities, because when you file a 15CA, it is e-filed on income tax portal. So the data is there with the government. Now, what is the change here? Now, all the remittances that you make round the year in Part D, the tax auditor is required to put a summary of that of those remittances in clause 43. Now, clause 43, as you see, it says any remittances reported in Part D, yes, no, and if yes, you look at the table that is reproduced, that's casted on the screen. So you have to club all these remittances by way of nature of remittances. For each nature of remittance, so assuming there is an expat who is in India, the expat from wherever he is seconded, they've made salary payments in home country, and today the Indian company is only remitting that payment that cross charge to the foreign company. So this is clearly something that is not subjected to tax. So assuming we have the first line item, remittance of salary already subjected to tax in India. Now, the tax auditor has to club different heads. Like I just gave you one example for whatever is the nature of payments, they are clubbed here together. Then the number of transactions of such remittances, how many remittances you made of those nature during the year is put in column C, the amount in column D, and most importantly, again, an increased burden on tax auditor. They'll have to tell, the tax auditor in his opinion will have to tell in column E and F that whether that amount was chargeable to tax or not in tax auditor's opinion. Now, assuming you are taking a position today that payment remittance is not subjected to tax, but the tax auditor has a different opinion and reports it, in E and F respectively. So this may become a clear case of disallowance from department side. So I think today you will have to revisit all your filings that you're making in Part D to promptly plan this disclosure to be made by the tax auditor. So I feel what is the consequence of this amendment? I think this amendment in for tax audit form is department will now have a very meaningful data. We have been seeing flurry of notices issued under 133(6), and mostly they require that you've made remittances outside India. Please give us details of Form 15CA, 15CB, explain the nature, and then it may or may not lead to a 201 proceedings. I think all that effort which department had to undertake is now passed on to the tax auditor, who will first give his opinion, and it makes the task easier for the tax authorities. Now, I think the positive side of this change is that you may start receiving lesser notices from tax authorities, but the negative side is you need to be prepared, planned today in terms of the positions that you are taking here. And also, the department would easily know what are the nature of remittances that they want to dispute and issue notices. So it makes life easier for the tax authorities. The next change is with respect to the TDS and TCS returns. So what we've reproduced on the screen is clause 50 and item B, 50B, particulars of statement. Now, if you look at this is information with respect to filing of TDS and TCS returns. So where the taxpayer is filing TDS, TCS returns, in the table, column A, B, C, D were same as they were in the earlier tax audit form. Now, the last column in the earlier tax audit form is what we've reproduced in this gray on the right side, whether the statement of tax deducted or collected contains information about details, transactions which are required to be reported. If not, furnish details, very subjective reporting. Now, this subjectivity has been removed and column E, F, G are added, which are star marked. This is added in the new tax audit form. Now, the tax auditor is required to specifically call out in the report number of transactions reported, number of transactions not reported, and amount with respect to transactions not reported. Now, again, increased work for the tax teams, in-house tax teams and tax auditor, and giving very meaningful data points to the tax department. So this is another significant change where we need to be geared up in advance. And we have exactly same amendment made with respect to SFT. So on the top right side of the slide, the SFT reporting was there in previous form, but the last three columns, which are identical to what we discussed with respect to TDS, TCS, have now been added. So even for SFT, this is increased reporting compliance for companies. At the bottom of the slide, we are dealing with reporting of unquoted shares incorporated in the form. Now, this is a new clause that has been added in tax audit report and extremely for any company, any taxpayer purchasing or selling shares, unquoted shares. Now, if you read the headings of the columns, typically any detail with respect to the transaction of sale purchase, which is required for correct computation of the capital gains, is plotted here. Now, the tax auditor is required to independently look at all of those data points reported in the tax audit report. And the beauty of this change is whatever you are submitting today in terms of the face value, book value, fair market value, impact of 92 to M, which is the earlier 56 to 10, the famous deeming provision of 56 to 10, all of that gets plugged in the tax audit report today. So you have no way to retract from anything that you submit today. So this is I think, a very significant change for sale purchase transactions, and also this goes into the tax audit report for both seller and buyer. So also the department will be able to cross-verify reportings made both by the seller and purchaser. Now we'll also cover some miscellaneous, changes in the tax audit report. It's not just the sad story. The good part is indirect tax reporting has been rationalized. I have personally handled cases where just basis of this GST reporting, which was there in the previous form, we've seen additions of 700, 800 crores being made just with that because of one reporting in tax audit form. That pain is gone. Let me give you an example. You import goods from outside. The other party is not required to be registered under GST for various reasons. Now, with the reporting that was available in the earlier form, tax auditors used to just add back that amount. Now, in the new reporting, first of all, the data points have been reduced with respect to GST. Secondly, there is a single line item where the tax auditor is required to specify amounts where GST is not paid because the other party is exempt. I think this is a welcome change, both in terms of simplification and clarity, and it will cut down litigation on this GST arising out of this GST reporting and tax audit report. The next is with respect to AMT and MAT credit utilization. Finance Act 2026 had inserted this new provision. MAT credit will see a sunset as of 31st March 2026. And from tax year 26, any company which is under the old regime and migrating to the new tax regime will now be allowed MAT credit or in a phased manner in the coming years. Now, this amendment, this inclusion of this utilization details in the tax audit report is in sync with this, requirement of the new amended law, so that the MAT credit utilization data is vetted by the tax auditor and made part of the tax audit report itself. The next change is with respect to details about the books of accounts. The new form requires that the tax auditor states that where is the location of the books that's maintained by the taxpayer, what accounting software is used, if any cloud storage is used, the IP details, the country, along with the Indian address of the location of backup server. I don't see this as a hassle for the company Under the Companies Act, we already have a section, I think 128 and Rule 3, which casts these obligation for companies. All that tax audit is required is a tax auditor is now required to do is just put all those details in the audit report form. So those compliances were anyways right now being complied with by all the companies. The next two changes are Aadhaar is now not required to be reported in the audit report, and residential status is now required to be reported. I don't see any difficulty because your income tax return form already you are citing your residential status. So this is just an added information bullet in the tax audit form with no consequences. I think last point, again, a welcome change. Currently in the tax audit form, we put, the payment-wise details for statutory payments like PF, ESI. Now that is not required to be done anymore. The tax auditor is just in single line item has to restrict the reporting to the amounts that are disallowable. So this reduces some work for the tax auditors and the companies. I think that's all on tax audit report changes.
So, Shelly, when I'm looking at these changes, I think quite a few from a tax audit perspective. So, what I'm also getting a sense is it's not just the changes are for near future. The government is also planning. I think they somewhere have the next steps also in their mind clear, maybe which they have not brought in right now. But they're just preparing the ground for the next steps. Any thoughts you want to share on them?
100% agree with you, Jayant. So if you look at the changes in entirety, so rather than basic disclosures of transactions, so now we are moving to a more structured reporting or a data-driven reporting. So we are ourselves giving a lot of data points to the government, which will make it easy for them to, one, decide which cases need to be scrutinized, and what is to be seen. So it's making life easier and it'll be all computer based. So the kind of changes that we see, it does not really need manual intervention. A lot of it can be done through automated systems. So this is certainly preparation for future that I see.
Yeah, because somewhere income tax, Department Authority is also talking about future use of AI, and I believe with the kind of information which they are now trying to capture, we got to be very, very careful about what we are feeding into the system as well. Yeah.
Yes, I think with use of analytics, they will be one step ahead the taxpayers. So it is extremely critical for the companies. And that's why I said that from day one, because you don't get a chance to move back in time next year at the time of doing a tax audit filing. So every company, every taxpayer will have to prepare themselves today, starting today, for these changes that have been brought in.
Right. These are actually very interesting ones. And you covered very, 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 very thoroughly. Thank you. SI.
Yes. So now after the detailed discussion of the tax audit report, which is the earlier form 3CA, 3CD or 3CB, 3CD, the next the another audit report which is relevant for any company having international transactions or any specified domestic transactions is the transfer pricing report, which we call as Form 3CEB in earlier era. I think if you see the Form 3CEB in earlier era, where it's like one has SSC details, what exactly we are. And it's a simple format on a very transaction level. How many associate enterprise were there? It will be very similar terms, related party as per the definition of associate enterprise in income tax. So what are the associate enterprise? What is my relationship with that associate enterprise? And what is the aggregate value of the transactions with my associate enterprise? And what type of transaction it is? Is it like any sale of goods or purchase of services or any capital goods or any purchase of intangible property, purchase of any tangible property, and kind of any interest loans? These are the different types of nature of transactions which we report in earlier 3CB. There are just three parts: Part A, Part B, Part C. Part A cover SSC details. Part B speaks about the international transaction details. Part C speaks about specific domestic transaction details. So that's a very simple form which we have been habituated. So it's a simple which we are filing from the last years. But now from 26, 27 onwards, there is a drastic change in the Form 3EB, which is the Form 48 now, because now the department is seeking in detailed discussion on the how you arrived at the arm's length price. Because in earlier 3CB, we haven't disclosed what is the methodology and what is the computation details of the determining arm's length price. It just speaks about what is the total transaction amount, do you have any receivable or payable, and which method of transfer pricing method, like is it resale price method, transaction net margin method, comparable uncontrollable price method, or any profits method, or any what other methods. It just speaks about which method you are using and what is the total transaction value. It doesn't speak about how you arrived at arm's length price. It just speaks about whether it is at arm's length price or not. But now, if you see this Form 148, which is the new form, this runs about many pages where it speaks about for each and every transaction, which method we are using and how we arrived at arm's length price. So this is on a good sake, because earlier we filed 3CB and then the TP officer, transfer pricing officer, will give notice, and then we submit the TP study report, and then he has his own comparable checklist, and then he determine again another method. It's like very long process. Now, as you also got a flavor how the tax audit report was already modified, the similar way the department is seeking a lot of inputs on a lot of data points from our side, where we give the information and then they'll see what exactly they want to do. That's where in this Form 48, we will directly discuss what is the primary adjustment. That's what the Form 48 was framed of. If I just try to brief what exactly the Form 48, the earlier Form 3EB. Now, the Form 48 has divided into 6 parts. Earlier it was 3 parts, Part A, Part B, and Part C. Now it is 6 parts. Part A speaks about the necessary details, what the company and all. And Part B speaks about the total value of international transactions or specific domestic transactions. And Part C speaks about international transactions and associate enterprise, and also plus advanced pricing agreements if you have entered any with any of companies, multi APS or what unilateral APS. And Part D speaks about specific domestic transactions and related parties, which is still same in the old Form 3EB. Now Part E and Part F are the new parts which we are supposed to give much more details in the Form 48 when we compare to the previous forms. So I'll go in detail how these forms have been categorically changed, because now the government has introduced a unique ID system where they want to monitor each associate enterprise level and also the transaction level. So if I just see the left side of the screen where it speaks of the identification of AE, that's identification of associate enterprise. So the intention of the department is they want to allocate one unique ID for associate enterprise and also for the associate enterprise in the transaction. So they want to allocate each separate ID for associate enterprise and also associate present transaction to monitor entire transaction of this associate enterprise and also the transactions forever, not only for this and the coming years also. That was in this Form 48, there's a new unique ID system has been incorporated, which is auto-populated whenever we fill the details like name of our associate enterprise. When we give all the details in the relationship, it is auto-populated. There is no specifically we want to generate this new ID. Okay. The second point is when we have this new associate enterprise ID generated, and also we need to give what is the nature of transaction with the associate enterprise. Is it relating to any sale of rendering of services, any capital financing, any purchase of immobile property, any purchase of goods. So there are around 16 to 17 level of transactions which they have been incorporated in Form 48 as a drop down where we need to select that. And much more, this Form 48 has been very categorically changed so that in this Form 48, they have been incorporated the details of the services. For example, if I have selected the rendering of service as my nature of service with my associate enterprise, it is asking what type of service. Is it market service, marketing service, R&D, accounting audit service, or if you want any IT development service, it is asking each and every detail of what is the nature of transaction of service which I'm associating with the associate enterprise. So if you want to understand, it's a simple way we are giving each and every detail of the transactions which were happening with my company with the associate enterprise company. That's how we are giving entire the preliminary structure of the relationship between the taxpayer and the associate enterprise. But the more interesting part here is whenever there is a transaction which have been reported in the form 48, okay, and then where I should select which type of transfer pricing method I'm going to follow. Is it resellable price method, or it's transaction net margin, comparable uncontrolled, which we call cup method, profit split, or cost plus method. In that, now there is scenarios where in my experience I see clients where they just file 3CEB. Later on, they'll say at the point of when the notice comes or when the taxpayer transfer pricing officer gives notice, then they'll start preparing TB or transfer pricing study reports. So for that kind of SSEs, that flexibility is gone. You can't do that because this form 48, the transfer pricing study is to be done, and based on that, based on the study, how you have arrived at arm's length price. That means it is onus on the taxpayer that we should prove that this is the entire methodology as on my transfer pricing method. I am arrived at arm's length price. Let's, for example, I take transaction net margin method. That's because that's why I put this in the slide on the right side. Now, if I select the transaction net margin method as example, which we use in a lot of IT companies as a transfer pricing method, then I should disclose how many companies, comparable companies I'm selecting. Is it 1, less than 6, or more than 6? If it is less than 6, I'm going to arithmetic mean or median, which is 35th percentile or 65th percentile, because that's the range we usually take the transfer pricing margin. That's the arm's length price we all usually determine. So this entire work needs to be happened before you have been going to file form 48. That means any company which was supposed to file this form 48, usually the date is 31st of October after the financial year. That means for financial 26-27, the due date to file form 48 will be 31st October 27. For that, now we should be ready so that we should not give what are the margin at that point of time. We'll just disclose and then we'll file, and then the TPO officer will again, we should manage it. Those flexibility days were gone. Now, form 48 is a mandatory form for all the companies where they have all the companies or firms where they enter any international transaction with associate enterprise or a specified domestic transaction with associate enterprise. In that, let's take, we have opted for transaction net margin method. In the transaction net margin method, if you see the point, the Roman number 1, where I should select what is the base. Net profit margin is in relation to costs incurred, sales affected, or assets employed, or cost employed, or any other relevant base which I follow. Where this is a mandate, I should select, and then all the calculation with respect to them, how I arrived at arm's length price, I should able to portray, I should able to report in the form 48. And one interesting part, if you see the second point, amount of the base as per books of accounts. Now, if I say sales affected, because if I want to calculate my net margin as part of sales affected, then I should report what is sales as per my books of accounts in the Roman number A. And the B comes about rate of net profit margin realized as per books of accounts. That is, what is the rate of margin as per my books of accounts, which is I have realized. It's speaking about rate, not the net profit. So we should calculate the operating cost by operating profit by operating cost. We should mention here. And where C, which is a roll number 4, determines what is the amount of net profit. Now the D column where the transfer pricing study report will gives, because by calculating the number of companies, how many companies I have selected as comparable companies, and if it is an even companies or odd number of companies, by giving their 35th percentile and 65th percentile and taking the range of that and taking the average or median depends upon the particular calculation of the transfer pricing study report. At the point of time, I'll arrive what is the arm's length rate of net profit margin which is supposed to take it. That is before adjustment. That we should report in the column D, that is roll number D. If we have any specific irregular items which are not form part of my margins, then I should make that as adjustments in column number E. That's where I will come to arrive to the number which is the transfer pricing margin I should make in the as an arm's length price. Automatically that will become roll number 4, because D, which is the transfer price arm's length margin as per the transfer pricing study report, and the E is adjustments. Now, if you see the very important point here, now arm's length price for the, if you roll number 8, if I say arm's length price for the comparable uncontrolled transactions after adjustments. This is what the transfer arm's length price that we should maintain, that any company should maintain. If there is any difference in this particular column number B, sorry, column C and G, then automatically there is a adjustments that we should report for the transfer pricing adjustments. So here, if you compare Form 3CEB earlier, it doesn't speaks about primary adjustments. It doesn't speaks about what is adjustment that we are going to take here. Now here we are directly disclosing what is the arm's length price and what is the adjustments. That's where the transfer pricing officer will get to know what is arm's length price and what is the basis to calculate that, along with my the transaction value. So the adjustments factor is always captured here. So this is one of the scenario which I want to show here. Similar way, for each and every method we want to follow. Comparable uncontrolled price method, which is cup method, resale profit method, profit split method, cost plus method. For each and every method that we follow, this similar detailed report we should give how we have arrived at the arm's length price. What is it based on that? That's what the Form 48 has been reframed, and it's a transformation, transformed a very big form in the Form 48. Now, if I compare, now this form speaks about my detailed giving of the transactions. If I want to summarize that, disclosure of computation of arm's length price along with the adjustments. Now we need to discuss the travel expenditure of the employees, any reimbursement, where further we should give a detailed benchmarking analysis in the transfer pricing report in the Form 48. And if we have any kind of disclosures, any kind of advanced pricing agreements, again we should disclose in this new Form 48, which was earlier not in Form 3EB. Now, if you understand, how does it impact to any company, or how does it impact to a tax professional, if you want to understand? Because if you see the lot of changes, earlier it was just reporting of transactions. And now for any tax auditor who is certifying this form, should be very diligent that entire transfer pricing study reports is with him, so that he can able to put all the numbers plotted there, and then he's certifying this report based on the transfer pricing study report. And one way this is good with respect to any taxpayer is all the transfer pricing studies report already done. So it's a welcome move from the taxpayer point of view, because earlier you have to defer and then you are working on the later point, you are deferring that. Now this makes you mandate to get the transfer pricing study report before you are filing Form 48. In that way, you are avoiding unnecessary litigation on one side, because the transfer pricing litigation is long process where you should go for DRP or again CAD appeals or else ITA. It's a long process. They're minimizing the litigation process, and in one way, and another way, it is welcoming you to go a mandatory detailed TP study report before you file Form 48, which is one of pain area for who are not able to do TP study report earlier. And one more thing, if any client has royalty, if any taxpayer has royalty, or any client has a trademark, any taxpayer has technical fee, now they're asking a detailed list of the what is the agreement of date of royalty agreement, and what is the royalty percentage, and how much royalty you are reporting. Same with respect to any capital financing, you are supposed to disclose what is the total quantum of the capital finance amount, and from is it traded in rupees or dollars or pounds, which currency you are trading in the capital loan taken from them, and what is the rate of interest, and what is the transfer pricing margin. So for each and every transaction level, each and every associate enterprise level and transaction level, we are supposed to give each every detail and with along with the transfer pricing workings. That makes these forms needs to work much more time to consume, where the taxpayers and the tax consultants and professionals should be equipped with for the next year. I think a couple of questions. I think a lot of questions on this on the transfer pricing report. Will the AE is the same for all the future years for each entity? As per the FAQs, they have generated separate unique ID for that. So that is a unique across all industries. What income tax department has clarified that.
One question from Rakesh is, given that there is a safe harbor policy for IT companies, do they still need to perform transfer pricing study?
Yes, they have still want to perform transfer pricing studies.
I think interestingly, Jayant, Sai, I think again, what the changes that we see here are all data driven. I think these were the questions which were typically asked in a transfer pricing assessment, which they have incorporated in the form itself. So clearly, this also shows a change in the preparation for future by the department, and they'll have meaningful selection criteria for transfer pricing audit now.
And I was somewhere, reading some, somewhere yesterday that, somewhere this is all boiling down to or not just boiling down, because government is trying to open up the manufacturing sector, through PLIs and all. Somewhere they are also fearing that there's a misuse of the PLIs. Um, I believe it is also, with all the data driven, and specifically talking about the contracts, when were it is signed, when was those royalty agreements were in place, was it all in place, or was it has some of them come in effect because of some government schemes, policies? I believe I believe it is, and correct me, and I'm because my understanding in this subject is very, very limited. So does some of them also are playing some in the government's head, because they somewhere need to push some sectors, some and they don't want any kind of a pilferage to happen also.
So clearly, Jayant, and I think the core idea that you're indicating is right. Like earlier, as I mentioned, TP documentation or study, what we call, used to be done post-dated only when notices were issued. Now they require all of that, all of that to happen and in a contemporaneous manner, so that there is no afterthought that can be applied to all of this. All sectors or taxpayers, behave and report things in a real-time basis, so that you cannot look back and rework transactions, and everybody gets a fair chance and a fair reporting, through these disclosures.
And to
But
add on to that is respect, especially is transfer pricing, where we have been seen scenarios, the transfer price TP study report have been resubmitted manually to the TP officer multiple times.
Yeah.
Because now everything details has been given online itself while filing a form 48. Then there is no chance to do the manual intervention and manipulation on that.
Although I feel, the taxpayers will have liberty to rework their benchmarking once the multiple year data is available subsequently. So that is when, if the case is picked up for scrutiny, that provision is still there in law. But yes, I think largely you can't reinvent things. You have to report upfront. So that's the clear message, that comes from these updated form.
okay, before as we move next, we Shalini and I was just chatting. I realized this, while we thought 1.5 hours is more than enough for us, but in between we still realize that there is a lot to cover. Just want to get a thumbs up. I know there are, if you have already left, who want to wind up the day, but to all of you who are still here, just want to get a sense. Thumbs up if you're okay, if we extend it by 15 more minutes. If you're not okay, we will try and wind it up faster.
Okay, so I think there's enough.
So Shelly, you
consensus for
have
us
you have a lot of thumbs up and a few hearts also. So all ears to you.
Okay. All right. So I'll be covering up some day-to-day filings. I think 15 CACB is something which every company is already, I'm sure, must have used the new forms 145, 146, because post 1st April 2026, whatever remittance that you make to a non-resident, you need to make these filings. Now, what's the difference between the both? 15 CB, which is now form 146, is to be obtained from a chartered accountant. And 15 CA, which is now form 145, is the filing which is required to be made by the remitter taxpayer, which could be individual, company, whatever be the case. Now let's see what is the change. Now 15 CA, the form is structured into part A, B, C, D, which is same as before. In terms of applicability, there is no change. Part A is applicable where remittances are less than 5 lakhs during the tax year, irrespective of the taxability, where the remittances are more than 5 lakh in the tax year, and the taxpayer, or rather the remitter, has obtained a lower or a nil withholding certificate from the assessing officer, uses Part B. Part C is used where the remitter obtains a certificate from chartered accountant and the remittances exceeds 5 lakh rupees. And Part D is used where remittances are not taxable under the Income Tax Act without applying beneficial provisions of the tax treaty. So the framework remains the same. let's see what are the changes in Form 145. Now, as I mentioned, post 1426, all the remittances will have to be made under this new form. Now, with respect to taxability, the earlier section 195 prescribed that any payment to a non-resident, TDS will have to be withheld if the sum is chargeable to tax. Now, with respect to this principle, there is no change under the new law. It continues to govern the withholding obligations applicable to non-residents. In terms of changes in forms, now with respect to the non-resident payee, you have to mandatorily quote the tax identification number, which is similar to a permanent account number that we have in India. So that tax identification number has to be quoted or stated in the Form 15CA and country of residence. Now, the change is in the existing forms, or the earlier forms rather, I would say, it used to ask for the country where remittance is made. Now there is an additional field of country of residence. And we've practically seen, in fact, there is a case going on in investigation wing where remittances were made to a person which was resident of country A, but payments were made in country B. All of that was not factored in the form in the current way it is. And typically for, tax havens, sometimes this information becomes critical. And also country of residence is extremely important to decide which is the correct treaty benefit that you need to take. So while I'm making a payment to, say, a bank account in UK, but I'm making payment to a non-resident who is tax resident of Singapore, I will not use India-UK tax treaty. I will in fact I will look at India-Singapore tax treaty. Now that information was right now missing. However, in this case, if you would have quoted India-Singapore treaty or India-UK treaty, the government never used to get to know what is the right treaty to be applied. So I think to fix that gap, this change has been incorporated. And tax identification number is important so that you can identify which assessee are we really dealing with. So who is the payee? Because this is a unique identification number allotted in the country of residence of the recipient. The next change is just a movement, a structural change, that country to which remittance is made is now moved from remedy to the remedy section to remittance section. So the form has been given headings and it's divided into in a very more structured format with headings. So it's just a move from one section to another. Now, with respect to details of the chartered accountant, so where 15CA Part C is filed, now in that case, you have to give details about the chartered accountant. Now, what's now added is you have to disclose the PAN of the chartered accountant, which was not a requirement earlier. And in case of, sole proprietorship, so where a chartered accountant is practicing independently and not as part of any partnership firm, his member registration, his or her member registration date is now to be additionally quoted, and UDIN is to be quoted. While practically we've seen that in 15CB filing, you can submit the form without the UDIN, but at a later point, you have to update it in the system. So you have a choice to now whether you put it in the form itself or subsequently put it on the income tax portal. So this is the change with respect to disclosure for chartered accountant section. Now, DTA related disclosures. There is a mandatory justification where income is claimed on as non-taxable under the treaty. So earlier in the forms, when you say that, yes, you avail a treaty benefit, there used to be sub items, whether the payment is in the nature of a royalty, FTS, interest, capital gain, or it's not taxable for any reason. So earlier, the justification of the reason was to be given only in the residuary bucket, but now it has been incorporated in under every bucket. So if you are making a payment, let us say this is an example when there is an expat whose salary is discharged in India, tax under 192 is paid, but you make a cross charge to your group A. Now that remittance is not taxable. So if you're saying that this is not FTS, not capital gain, not business income, you have to give reasons for each of the item that why it is not taxable as royalty FTS, why it is not taxable as interest or a business income, and so on and so forth. So this is the next change. There is a question on the tax in the chat box with respect to TRC. Yes, this is a new reporting requirement, which is now added in 15 CA as well as 15 CB. So it is not just TRC, TRC number also needs to be created. Now, what is TRC number? In every country, TRC is issued by the tax authorities of those countries. Now, in our practical experience, we've seen some countries quote a certificate number, but we've also seen several tax authorities not citing a tax residency certificate number. So I think practically, at least for now, what taxpayers are doing where a TRC number is not available, they are putting the TIN number in the TRC number section because there is absolutely no choice of what else you can fill in, and it's a mandatory field. So these are some practical choices we are making right now, or clients are contemplating. The consequences are not clear, but clearly if the number is not available, there is not much with which any taxpayer can really do about it. Now in 15 CB, the information is largely the same. Now you would see every section is given a heading. So you have particulars of remitter, particulars of remedy, particulars of remittance, details of taxability, and TDS. So you have 5 clear headings, and all the clauses are summarized under those, covered under the respective headings. So which just makes the entire form very reader friendly. In terms of changes, the applicability of 15 CB, there is no change. Now, in the form, the remitter reporting, there is a change. Now, there is a dedicated section wherein the details of remitter has to be punched in, which now includes the residential status of remitter. Now, anybody making payment from India, I mean, it's an obvious choice that you select yourself as a resident. But we also see, shared transactions happening between two non-residents in case of an indirect transfer. So wherein the remittance from a compliance perspective, you have to file 15 CB and 15 CA, even though the payment is not made from a bank account in India. I think in those cases, and there could be, several other instances where a non-resident would be required to fill up this, obtain this form. And there you need to clearly and correctly choose the correct residential status. So this, to my mind, is again a data point where they want to identify where a non-resident is making payment, because those transactions are usually subjected to deeper scrutiny by tax authorities. Then there is a optional, requirement to report TAN. If it is available, it can be quoted. And then the email ID and contact number of the remitter. Now, in terms of remedy, which is the payee, additional details like TIN, principal, place of business, and country of residence. These 3 fields have been added for remedy. We've already discussed the relevance of adding country of residence in 15 CA. With respect to remittance information, now you are also required to quote the details of authorized dealer, which is the banker, while in most cases, the bank through which remittance is made and the authorized dealer may be the same. But there are a few banks who do not operate as an AD banker, where the AD banker's detail is also required to be quoted, along with the ITD REIN number, if available. Another significant change is with respect to the details which are to be reported for capital gain transactions. Now, under the erstwhile Form 15 CB, this kind of detailed reporting for capital gains was not included in the form. The new form requires you to put in all the details with respect to the transaction. As we also saw in the tax audit report, your purchaser and seller is required to quote details of unquoted shares transfer. Now, you also have a reporting to be done in 15 CB. So very critical that the data points you report under the 3 forms, 3 different forms, they should corroborate with each other, because this will become a very easy data point for the department that wherever there is a disconnect, in the tax audit report or 15 CB and the report filed both by buyer and seller, it's a very easy point of case being selected for scrutiny. So apart from 15 CACB, which I'm sure many of you may have already used, the other, I feel the most critical change is Form 41, which is the earlier Form 10F. And we have already been flooded with a lot of queries coming in from client because of a lot of practical issues being faced by them. So let's just see what is this form. So 10F. See, earlier in the earlier law, we used to take a position. Some set of clients used to take a position that if all the details are mentioned in TRC, a lot of companies used to choose not to obtain Form 10F. Practically, a lot of companies decided to, obtain this Form 10F e-file, on the e-filing portal section, because even for a PAN or a non-PAN cases, this could easily be applied online and obtained. Now, earlier for 10F filing, the TRC had to be uploaded. Earlier, this 10F could be revised. So for a particular financial year, you could have again got a Form 10F, multiple times on the e-filing portal. Now, this is what was available under the provisions or the procedure pre-31st March 2026. Now, what has changed? First, this 10F is now replaced with Form 41. It continues to be a mandatory e-filing. And now I think the leeway which some clients used to take on the mandatory or voluntary requirement has now been plugged in by the revised rule. So the language now is very clear that in all cases, Form 41, e-filed Form 41 is mandatory. So that is the first takeaway from the change. The second is, I'll first come to the issues here, rather than going by the bullets that you see on the slide. Now, typically, TRC requirement varies, and the TRC format varies from country to country. So why was this 10F and now Form 41 required? This is required because of the different formats used by different countries, so that the Indian government has a unified standard format and all the information that they require for analysis and data points is available in a synchronized manner. Now, today, the FAQs that have been issued talks about two things. One, Form 41 going forward, as per the FAQ, can be obtained or filed only once per tax year. I find this a very difficult FAQ to deal with and answer people's question being received by us, because it says no revision will be allowed. Now what falls? We are sitting in April 2026. You are a payer. You have to make a payment. You ask your, the payee for Form 41. Will they be able to provide you? In April 2026, in lot of countries, you will not get a TRC that early in the year. In several countries, they follow calendar year. Now, for the IRS of a respective country to issue a TRC, they usually like to wait for a few months so that they get some certainty regarding the residency certificate. Now, the taxpayer could be individual or company. Now, in case of individual, most countries follow residency based on stay basis. So if it is a calendar year 2026, the government would like to wait for 5-6 months to issue a certificate saying that, yes, Mr. X or Mr. Y is a resident of my country. In case of companies, the question would be that if it is incorporated in that country, why is the IRS reluctant to issue TRC that early? See, the answer to that in my mind is the concept of place of effective management. Now, POEM concept is applicable in several countries. So because of which the IRS of different countries, even in case of companies, they practically like to wait for some time to issue a TRC. So in my experience, in a lot of countries, you get TRCs getting issued in the month of August or September. So what do we do with respect to payments to be made from April till the point in time when you don't have a TRC? That's the first gray area that I see. The second problem is assuming we file, we obtain a TRC in August 26, that is issued for calendar year. Now we have to make payments on issue 41, form 41 for tax year 26-27. Now, because this filing can be made once, when you make a payment in January 2027, will that form 41 still be applicable? Can a tax deductor while making payment rely on that? Because interestingly, the FAQs have also mentioned or give the impression that this pre-filing of Form 41 is mandatory to get a treaty relief. So today, when I'm making a payment and you have a Form 41 not backed by TRC, or you're making a payment in January or February 27, which is not backed by TRC of 2027, will it mean that if I'm making a royalty FTS payment, instead of 10%, I need to do a 38% tax withholding? That will be an interesting space to analyze and take a position, and every company will have to take a position around that. So these are, I think, some nuances in the new Form 41 and the issues that have unnecessarily been created by the FAQs that have been issued by the government in the month of March. So that is about Form 41. I think the next one is 15G, 15H. Now that's clubbed into one Form 121. So irrespective of the age, whether you're below 60 or above 60 years, so there's a common form. More or less, the contents of the form remains the same. I think I'll take up 3 and 4 next, which is the changes in the PAN application form and the updation forms. So currently we have Form 49A and 49AA, which is now replaced by 4 PAN forms, 93, 94, 95, 96, depending whether you are individual or non-individual and Indian citizen, non-Indian citizen. So on that basis, these 2 forms have now been replaced with 4 forms. Now, why was there a need to change to 4 forms? I think what they've done now is the forms contain information that is relevant to each of these class of people who need to apply PAN. So that is a welcome change. So you don't have a lot of redundant clauses which you need to apply, which you need to state in the application. I will touch upon the pain point here, which we are struggling for our clients. I think a significant change here is relevant for foreign companies who want to apply a PAN in India. There is a new clause which requires you to fill details of authorized representative of such foreign company. Now, a foreign company, in the earlier form, you have to just give the name and designation of the authorized signatory or the authorized representative. So assuming you had Miss Kate, a director of a foreign company, so you would just write, I, Miss Kate, in capacity of authorized representative, verify, declare everything above is correct, true and correct, and sign the PAN application form. Now, under the new form, the requirement is that you need to give a proof of identity of the authorized signatory or the authorized representative. He or she should have an Indian address, and the proof of identity would mean a PAN or Aadhaar. So clearly, Miss Kate, just for applying PAN for FO1, will not apply for a PAN, right? Not apply for an Aadhaar either. And also would not have an Indian address. So clearly what the government wants is that for FO1, they want a touch point in India for communication, probably because in their experience in the past, they never had anybody whom they could communicate with whenever they wanted to get hold of the foreign company. So with this change, the foreign company, FO1 in this example, would need to have any person in India, maybe, somebody from their related party operating in India, but that would not be a case for all. There could be companies who do not have Indian presence. What do they do? They would reach out to their consultants. But the practical difficulty today here is neither an employee of an Indian company nor a tax consultant or a lawyer would be willing to disclose their name or will be willing to call out themselves as authorized representative of this foreign company. Now, the Income Tax Act does not spell out what is the obligation of any person who represents himself, herself as the authorized representative. To my mind, this is more of a communication channel. They want to make such person, but who would take a chance? With you never know. I mean, you are roped in for any personal liability. So in fact, we have some ongoing live deals where foreign companies need to apply a PAN in India, and we are still figuring out who can be the authorized representative. So imagine the entire deal closing has gotten stuck because of this procedural change. So this, I think, is going to haunt us for time unless the government really brings in some clarification here. I think, Jayant, you want to make a point here?
Yeah, I was, wondering. I think this is this may sound very small as a change, but this looks like a very big, very major change. Because you'll not be able to amend it also very easily. And so you somewhere, I think I look at it, that is that government intent that there should be some stake of for foreign entities subsidiary in India by an Indian owner, or is it somewhere uh, moving in that direction? But it will be interesting to watch, because this seems like a very major change.
Right. And in fact, Jen, similar change, for FPIs, there is a common application form. So whenever FPI has to register themselves in India to obtain any category 1, category 2 FPI license, under the common application form, the details have to be given and PAN is allotted. Now, for this kind of requirement, which is same as what we've seen here, the authorities, SEBI, has already contacted CBDT head that please clarify. I mean, our registrations are stalled because of this, because we are not able to find any or obtain any authorized representative of us. And what is really the rationale to bring in this change? So probably we will have some answers soon, because SEBI has already knocked their door. Perhaps government will come up with some clarification. At least they need to clarify what will be the obligation of person who choose to, decide to become the authorized representative. Because with Indian tax authorities, I'm sure even tax consultants would not want to take any risk in their personal name. Apart from this, for Indian citizen applicants, now we need to mandatorily specify their residential status. And for NR and not ordinary residents, they'll have to furnish their passport number in the application form. We'll also have for non-Indian citizens and foreign entities, their TIN has to be mandatorily reported in the form. So these are changes with respect to the new PAN application. For the changes in PAN application, we have new form CR01, CR02 for individuals and non-individuals respectively. The changes that we've observed in the form is mandatory furnishing of the registration number and TIN, and in case of individuals, passport number. So these are the only changes in the correction forms that we've noticed. Sai, would you like to walk through the transition?
Yes, Shalini. So I think all our audience might have understood what exactly the entire from part 1 and part 2, the income tax 1961 has been transitioned to income tax 2025. So what exactly, as an entrepreneur, as a business, what should we ready for that? So what changes that we should be able to incorporate in our business so that we are ready to implement income tax 2025 is what we just give a glance on that. The first thing is we should update all our ERPs and all our payroll systems so that we can able to see the new TDS section numbers instead of 194J, 194C, which are early ones. Because from 26-27 onwards, we should revert 393. I think, am I right, Shahid? 393 is the section number on TDS. So we should refer to that section number with along serial number, clause numbers. That is because we are going to file form 140 or 138 based on that. That is a one ERP based change we should bring to place, and we should be very careful which section we are going to deduct TDS 393 subclause 1 or subclause 2. Of course, it might be confusing, but we should be able to habituate to that. The second thing with respect to TDS computation is, as the terminology also changed from financial year, previous year, and assessment year to tax year. Now we should be very familiar to the word called tax year, and also whenever with the introduction of new labor code or with the introduction of the new income tax 2025 along with the new income tax rules 2026, with respect to the increased exemption limits for all HRAs, car allowances, medical benefits allowance, children education allowance, hostel allowance, what the pay structure revision that we are supposed to take place is what the employees should be think on to revision of the pay structures, considering the labor code impact and also the new income tax rules impact to be more optimal tax effective structure for all employees. And the third thing is what majorly we should be very prudent and very ready to train all the accounting teams, all the finance teams to with respect to the reporting of all the tax audit reporting, what Shelly has mentioned, and with respect to the transfer pricing report, what is supposed to be filed in Form 48. So what are the data points we should be made readily available from this day onwards, rather than we struggling to, because there are a lot of data points that we are supposed to report in Form 48 or tax audit report. Now we should be very ready. So with respect to all data that is ready to be placed from day one onwards, so that there are no sudden surprises after the completion of financial year. And similarly, all the valuation of perquisites, we should again revisit on that. And do you want to add any more thing on that, Shaili, with respect to these particular points?
Yeah, I think the bottom line side to my mind, and as an advisor, this is what I've been telling my clients also. See, you need to identify what is applicable in your case. So, the changes that we discussed today are not all, there are changes in the appeal filing forms, your form 35, 35A, 36. There are changes in those forms. If there is a slump sale, there is a change in erstwhile form 3CA, form 28 now. So there are many more changes. You need to identify what are the forms, what are the provisions applicable to you. From beginning of the year, you need to prepare yourself with respect to what's applicable, because see, everything has changed now. A consultant cannot reach out, help you with those changes. I think as companies, as taxpayers, you need to identify what's applicable to you. You need to evaluate in-house what are the changes, take necessary help, in terms of your ERP, our compliance support on the technical positions. Also weigh in the impact of these changes in terms of what litigation dispute that can be foreseen with the changed reportings. So I think those are the next steps which companies need to undertake. And of course, compensation restructuring is something we are already seeing a lot of inquiries coming in from the clients. So that is one space where clients are already active. But what I'm emphasizing is there is much beyond compensation restructuring. There are a lot of things which you need to plan and gear up for these changes. So while FM is saying there is no policy change, there are silent killers in the act. We've seen some cases where we've advised earlier, and just by dropping 2 words, the position has changed. Those are not advertised, those are not spoken anywhere by the government, but there are minute changes which will flip your tax position. So one really needs to read very carefully the new provisions with the reshuffling up and down. At times, even, in our office, we'll have 2 people studying the same change before advising, because there's a lot of reshuffling where, if you do not read the provision of the change, you may end up taking a wrong tax position. So this is the preparedness that's needed today, I believe, in terms of transitioning to this new framework.
And with respect to the points what we discussed today, with respect to Form 15CA, 15CB, or tax audit report, or the new PAN application, now we advise the clients who are with respect to onboarding vendors. So we should collect Form 41, which is the Form 10F earlier. So make them very mandatory. So each and every aspect of the day-to-day operations of the business, all these changes needs to be captured in a well-versed manner, so that there are no sudden litigation happens in the future. That's on the one part. And the second part is with respect to whenever there's a transaction comes, because as you use a very good word, which I was very happy that the silent killers. So there are a lot of words that have been used in this particular income tax 2025 or 2026 rules, where this might come up with a slight change in the tax positions, because they have used or end in multiple times, and they have used the accrual or the realized, they have used different terms just for sake. because this change in the terms, even though our intention having income tax 1961 in our mind, we may be pursued as the same intent. But definitely this will land up in different kind of legal position at certain point of times. So in a nutshell, to a holistic, if you want to advise the clients for each and every aspect of any transaction that you are taking care, please refer as a new first time reader with respect to the new rules, where you're onboarding new vendor, we are making any payments, so that you are ready for all kinds of reporting at the tax audit report or 50 CACAV report or just form 145, 146 or form 148, which is for transfer pricing. And we have all other reports, which are, there are a lot of increase in reporting which you have in the next coming months, because we have not got all the new forms. There are multiple new forms which are applicable for NGOs, private trusts, normal business aspects. So this way, the readiness for any business should be at transaction level and also at year-end closing level and also audit level, so that we are not ending up within litigation.
Absolutely agree with you, Sai.
So, just more of a closing remark, Shari and Sai. I just want to. I also feel that somewhere, I think we've already tried take up a lot of questions already. I believe while some of the things may look overwhelming right now, but somewhere I also get a sense that some of the intent is also to reduce the prolonged litigations and conflicts also. By putting more of things in more in structure, trying to bring closure to things by reducing the timelines gaps. And I believe, as you said in the beginning, from 60 to 2026 now, we are I would say we've not just almost a century old in this system was there. A lot has changed in terms of our technology which we are using, in terms of how kind of resources we have. I believe it may sound a little tough right now to adjust to changes, but uh, these changes will also bring more sanity in the entire system. What are your thoughts on this?
See, Jayant, I'm not doubting the intention behind, bringing this new act. Definitely, it's a commendable move. Um, Barring few areas, I mean, it really makes a lot of sense the way new act is brought in. I can quote you examples that where me as a tax professional used to dread with certain provisions of the act. They were scattered all over from section 2 to 115, all of that bringing together into one chapter, making life easier. So let's also appreciate and look at those positive sides. So certainly, I mean, the entire change is appreciated. It's just about getting used to the new law. And even the revisions that we see on the salary perquisite valuation side, that's basically to just come up to speed with the inflation, and make those exemptions more aligned with the cost of living today. So overall, all in all, I think it's a positive side. It is just human tendency or the reluctance to, adapt to change, which I think maybe in a year or two, we all will start loving this new act.
Yes, with all a lot of new laws, I believe. If I look at the last 1 year, there's a lot of webinars which we have done, somewhere in the DPDP, somewhere we're talking about labor codes. The RBI has kind of revamped everything. Now the Income Tax Act, we are waiting for SEBI to come up with all the changes. I think we'll not be left with the option but to love them.
Adapt to change.
We'll have to change. That thank you so much. And I just realized, we've spent slightly more than 2 hours, and somewhere in the middle, I was actually realizing uh, we tried to cover a lot, but these subjects needs not just not just 1 hour webinar. It needs a master class because there's too much of a depth into it. Yet a lot to explore. There were, in my mind, also there were a lot of questions, which obviously I knew that there is limited time. I didn't want to ask many. Uh, but Thank you so much, Shelly. It was really an interesting session. Somewhere I'm not a tax professional, but somewhere I was also lost into this the entire discussion. Very interesting. Thank you so much for your time. And Sai, thank you so much twice. For continuing the series two. And I believe we will have many more questions, and I would urge your possibly you to come back again on clearing those doubts, because I think we've just I don't think many have started even reading these laws. And I think Shelly, you've done a very deep dive into it already, but I don't think many have even started reading this act. When we start over the next 15 months, I would say we are going to be actually looking at what kind of a changes it has brought to us for us.
I agree. It's actually quite overwhelming, to really pan out or map the entire act with changes. But that's where I think platforms like these help. Today, we've given an overview. And as you rightly mentioned, each and every change really have a lot of gray areas, some with which we are also grappling right now, identifying these areas and, bringing solutions to our clients. So yes, I mean, certainly I would agree that everything requires a deeper analysis, but I think it's a good overview for people to decide what's applicable to them and start reading up and prepare for the tax year, I would say.
Thank you so much. And thank you so much, everyone. It's already 5:30. I'm sure you had to wind up. But I'm sure you found this as interesting as I did. So looking forward to more sessions. I believe we'll have to do more on this subject. It's all evolving right now. Thank you so much, Shelly. Thank you once again. Bye. Thank you.
Thank you.
And
Thank you,
look forward to
gentlemen.
many
Thank you to all the, patient attendees who've been with us till the end of the session.
Thank you.